Welcome back to the Deep Dive. So it's February 2026, and I want you to picture something for a second. Usually, when we talk about markets, stocks, bonds, whatever, we're all visualizing these abstract numbers. You know, red lines, green lines, tickers flashing across a screen.
Yeah.
It all feels like data just floating in a cloud, right? But right now, something is happening in the silver market that is sort of grabbing everyone by the collar and reminding them that, no, this is about real, heavy, physical stuff. We're talking about massive bars of metal sitting on pallets in a warehouse.
It is a fascinating moment. We're seeing the machinery behind the curtains start to groan a little bit. It's almost like the check engine light just flickered on the dashboard of the global commodities market, and everyone's trying to figure out if it's a sensor error or if the engine is actually, overheating.
Exactly. And normally, we wouldn't pay attention to the plumbing of the financial markets. It's boring, it's back-end stuff.
For the accountants.
Right. But when the plumbing starts making that clunking noise or when the water pressure drops, you probably need to go check the pipes. Today, we are doing exactly that. We're diving into a really timely analysis titled COMEX Silver, Impending Physical Shortage. This comes from Doug Young.
Right. And for those who might not track the bylines in this niche, Doug Young is a heavy hitter. He's a financial markets researcher with over 20 years of experience, and famously, he was the former financial director at World Freight Services. So he isn't just a chart guy. He understands the logistics of moving heavy things around the planet. This report was published just recently, February 14th, in the Gold IRA Company's Bulletin.
So we've got a logistics veteran looking at the financial charts and saying, hey, wait a minute, the math isn't matching. Now, before we get into the nitty-gritty of vaults and delivery notices, and we are going to get into the weeds today because that's where the story is, we have to say our usual disclaimer. We are here to learn. We are unpacking the mechanics of the global silver market. This is absolutely not investment advice.
No, we aren't telling you to buy, sell, or hold anything. We're just looking at how the machine works.
Precisely. We are looking at market structure, not trying to predict the price.
We're trying to understand the engine, not guess where the car is driving next.
Okay, let's set the scene. It's February 2026. Doug Young points out that there is this central tension brewing. It's the battle between paper silver, which is just a contract, a promise, a digital entry, and the actual physical metal sitting in a vault somewhere in New York or Delaware.
That's the core conflict right there. You have the futures market, which is massive, trillions of dollars in notional volume, and then you have the physical market, which is finite and, well, surprisingly small. Usually they dance together nicely. The paper price reflects the physical reality. But Young is arguing that recent activity suggests they might be drifting apart. The map no longer matches the territory.
Let's unpack that, this map versus territory idea. Because I think for most people, the market is just a casino. You place a bet, you win or lose money. But for silver, there's an actual warehouse involved. So let's start with the basics. What exactly is COMEX?
So COMEX is operated by the CME Group. It is the primary exchange for trading metals, futures gold, silver, copper. It is the place that effectively sets the global benchmark price. When you see silver is up 2% today on the news, they are almost always talking about the price discovered on COMEX.
Okay, so it's the price setter, the referee. But how does the game actually work?
Yeah.
If I go onto my brokerage app right now and buy a silver contract on COMEX, am I buying a bar of silver?
Well, yes and no, but mostly no. You are buying a future. It's a standardized legal agreement to buy or sell a specific quantity of metal at a predetermined price on a future date. You aren't buying the metal now, you are buying the obligation to transact later.
A promise to buy it later. Like putting a deposit down on a house, but you haven't moved in yet.
Similar, yes. But here's the statistic from Doug Young that really blows your mind when you first hear it, and it frames this whole discussion. Historically, over 95% of these contracts never result in anyone actually touching a bar of silver.
95%.
Yeah.
So the vast majority of this silver market has no silver moving anywhere.
Essentially, they are settled financially. That means before the contract expires, the trader either sells it to someone else or rolls it over to a future month. They're just betting on the price movement. They are hedgers or speculators. They explicitly do not want 5,000 ounces of silver dumped on their driveway.
Right, because who has the space for that? And also, you've got the hedgers like miners trying to lock in a price, or an electronics company that needs to lock in a cost. They use the paper to manage risk, not necessarily to go shopping.
Exactly. It's a risk management tool. So for 95% to 99% of participants, it's just numbers. But, and this is the aha moment in Young's report, that remaining 1% to 5%. For them, COMEX isn't a casino. It's a store. It's a delivery mechanism. They actually want the metal. They are standing at the counter saying, I have the ticket, give me the product. And the exchange has to be able to provide it.
And that's where the tension is right now. Because if everyone decides they want the metal at the same time, the casino runs out of chips, or in this case, bars.
That's where we get into what I call vault logic. To understand why February 2026 is so weird, you have to understand the inventory. Doug Young highlights a critical distinction in the COMEX vaults that most people miss. And honestly, the industry relies on people not understanding this. It's the difference between eligible and registered.
Okay, lay it on me. I feel like these terms are designed to be confusing. What's the difference?
Think of eligible silver as silver that is stored in the COMEX vaults and meets all the quality standards, purity, weight, brand brands. But it is still under the control of a private owner. It's just parked there.
So it's like if I rented a safety deposit box at a bank and put a gold bar in it, it's physically inside the bank, but the bank can't just grab it and give it to a customer. It's mine.
That is the perfect analogy. It is not available for delivery to fulfill a futures contract unless the owner explicitly says so. Now, registered silver is different. That is silver that has been formally set aside to fulfill contract obligations. It has a warrant attached to it, is the delivery buffer. It's ready to go.
So using the bank analogy again, registered is the cash in the teller's drawer. That's what's available if someone walks in and says, I want to cash out my check.
Exactly. Eligible is the safety deposit box. Registered is the teller's cash tray. And here's the stress point Doug Young identifies in the report. The amount of registered silver, the cash in the drawer, has been trending lower.
So the buffer's getting thin.
It is. And this is a dynamic situation. Can eligible silver become registered? Yes. If the price is high enough, a private owner might say, okay, silver's at $40, I'll sell my stash. They fill out some paperwork and boom, it moves from the safety deposit box to the teller drawer. But the key is they have to want to sell it. The exchange can't force them.
That seems like a pretty big vulnerability in the system. If the registered stocks get too low and the eligible owners are hoarding their stuff because they think the price is going higher, you get a squeeze. The teller runs out of cash.
Precisely. And that brings us to the anomalies of February 2026. The plumbing is starting to make that clunking noise.
Right. Let's talk about the timeline. Young mentions that February is usually a minor delivery cycle. I didn't realize there were seasons for this. What does that mean?
Futures contracts have different expiration months. Some are major, lots of volume, lots of action, and some are minor. Usually February is a quiet month, a generic month. Most traders just roll their contracts over to the next big one. It's sleepy. But in early 2026, we saw unusually robust participation.
So instead of rolling over, which is basically selling the February contract and buying a March or May, one more people than usual stood up and said, no, I don't want to roll this over. Give me the metal. I want delivery.
Correct. The activity exceeded expectations relative to the open interest. It's like seeing a packed parking lot at the mall on a Tuesday morning. It's an anomaly. It signals that something is shifting in the behavior of the participants, and this is happening right before March.
And March is the big one.
March is a primary delivery month. Young calls it the key test. If February, the quiet month, was stressful, March could be a breaking point.
Why is it a test? What happens on the calendar?
It comes down to first notice day. That's the deadline, where the people holding long positions, the buyers, have to declare if they intend to stand for delivery. If we saw this much pressure in a quiet month like February, the fear is, what happens when the big rush comes in March?
It's like seeing a long line at the grocery store on a Tuesday morning. If it's busy then, you know the weekend rush is going to be chaos.
That's a good way to put it. Elevated delivery notices signal a shift in psychology. It means the market participants are moving from paper settlement, just trading cash, to physical settlement. They want the asset. They don't trust the promise anymore. They want the proof.
Which begs the question, why? Why is everyone suddenly wanting the actual metal in February 2026?
Well, Young points to the supply dynamics. Silver has this split identity that makes it very unique among commodities. On one hand, it's an industrial metal. It's in solar panels, electronics, batteries, medical devices.
The green energy transition. You literally can't build a solar panel without silver paste.
Exactly. It's a strategic commodity. We are building a world that runs on electricity, and silver is the best conductor of electricity. So you have industrial fabrication eating up supply because they need it to build products. They don't care about the price charts. They need the metal to keep the factory running.
And on the other side?
On the other side, it's a store of value. It's poor man's gold. So you have investors buying coins and bars because they're worried about inflation or the economy. Both groups the factory owners, and the nervous investors are competing for the same physical bars outside the exchange vaults.
But wait, I have to play devil's advocate here. Silver is a global market. If there's a shortage in New York, can't they just ship some over from London or Shanghai? Can't they just fly it in?
You would think so, and in a perfect world, yes. But Young points out the logistical friction. He specifically mentions regional disparities, particularly in Asia. There are shipping constraints, insurance limits, regulatory hurdles. You can't just teleport 10 tons of silver across the ocean instantly to fix a localized shortage.
It takes time. And time is money in this game.
It takes time and it costs money. And that leads to what Young calls the tell. He noticed something about the premiums.
Talk to me about premiums.
The premium is the extra cost you pay above the spot price to get a physical bar in your hand. So the screen says silver is $28, but you go to a dealer and they say, sure, $28 is the paper price. If you want this bar, it's $35.
So a $7 premium? That's massive.
Exactly. Young notes that even when the paper price dips or corrects on the screen, the physical premiums have held firm.
That's the disconnect again. It's like the real world is ignoring the stock ticker.
It proves the physical market is tight, regardless of what the paper market says. The paper market might say sell, but the physical market is saying we don't have enough.
So let's play out the stress scenario. Doug Young makes a really interesting comparison to fractional reserve banking. I think most people loosely know what that is, but how does it apply here?
This is where it gets really juicy if you like market mechanics. In banking, a bank only keeps a small fraction of your deposits as cash in the vault. They lend the rest out. It works fine unless everyone wants their cash at the same time.
A bank run. It's a wonderful lifestyle. Everyone's screaming at George Bailey.
Right. COMEX operates somewhat similarly. There is a high open interest, the total number of paper contracts, relative to the amount of registered metal in the vaults. The system assumes it relies on the fact that 95% of people won't ask for the silver. It is a rollover dependent system.
So what happens if they do? What are the defenses? If I'm running COMEX and I see the vaults emptying out and I see March coming, what do I do?
Young outlines the management tools. The exchange isn't helpless. They have a few levers to pull. The first line of defense is margin hikes.
Make it more expensive to play the game.
Exactly. To hold a futures contract, you have to put up a certain amount of cash margin. If the exchange raises that requirement, suddenly it costs you a lot more to hold that position. This forces the smaller speculators to sell and leave the market.
So you shake out the weak hands, you squeeze the little guy out to save the inventory. That seems effective, if not entirely fair. What else?
Position limits. They can just tell a single trader, you aren't allowed to buy anymore. Or, you're holding too many contracts, you need to sell some. They can cap the whales.
And then there is the EFP exchange for physical. This is a fascinating bit of backroom dealing. Tell us about that.
This is basically a deal where the exchange says to a trader who wants delivery, look, we know you want the metal, but we're tight right now. How about we give you a cash settlement that is slightly better than the market price? And you just walk away.
The we'll pay you to go away strategy.
It's a negotiation. And usually it works. Most traders are rational. They'll take the profit.
But Young mentions a nuclear option, something called force majeure. That sounds serious.
Yes. This is the break glass in case of emergency option. Force majeure is a legal clause that frees both parties from liability when an extraordinary event occurs.
Like an act of God. An earthquake destroys the vault.
Or, in this case, depleted stocks and failed sourcing. If the registered stocks hit zero and no one with eligible silver wants to sell, the exchange could declare force majeure.
Which means, oh, sorry, we can't deliver, here's your cash back.
Essentially, yes. But Young notes that history shows exchanges hate doing this because it destroys confidence. They usually prioritize pricing adjustments over shutting down.
Pricing adjustments. That sounds like a euphemism.
It means they let the price rip. If there isn't enough silver, the price should rise. It should rise until it hits a number where those guys with the eligible silver in the safety deposit boxes say, okay, at $100 an ounce, I'll sell.
So the price skyrockets until the hoarders unlock the vaults. That's the self-correcting mechanism.
That is the theory. But if the physical shortage is real enough, that price spike could be violent. It could be a vertical line on the chart.
Okay, I want to get tangible for a minute, because we talk about delivery like it's Amazon dropping off a package.
Sure.
Let's say I'm one of the stubborn ones. I bought the contract, I refuse the cash bribe, and I want my metal. What does that actually look like?
It is definitely not like Amazon Prime. Young describes the physical reality. First off, one COMEX contract is for 5,000 troy ounces.
Whoa. Okay, Can you contextualize that? How big is that?
That is roughly 340 pounds of silver.
340 pounds. Okay, so I'm not putting that in my backpack. I'm not even putting that in the trunk of my sedan.
No. And the process is incredibly complex. It involves random assignment to shorts, the sellers. Then you get a warrant. And then you have to arrange to load out the bars from a vault in New York, Delaware, or another approved site.
You have to hire an armored truck.
Pretty much. And you have to pay for it. There are logistical hurdles everywhere. Young makes the point that this complexity is a feature, not a bug. The friction is high. That is why low delivery rates usually preserve liquidity. It's a pain in the neck to take delivery, so most people don't do it.
It's almost like the system is designed to be just annoying enough that you'd rather take the cash.
It is certainly optimized for financial settlement, not physical distribution. But here is the crux of the argument. When the premiums for physical metal get high enough, when the street price is way higher than the paper price, it becomes worth the hassle.
If the spread is big enough, I'll hire the armored truck.
Exactly. If you can buy it on COMEX for $28 and sell it on the street for $35, you will deal with the paperwork. And that's when the mechanics get exposed to stress.
And that's what makes this February 2026 data so interesting. Despite the hassle, despite the armored trucks, people are doing it.
Yes. The divergence is the key. Young mentions that COMEX prices influence everything. If COMEX breaks or even hiccups, it sends a signal worldwide. It tells the world the paper price is wrong.
So, bringing it all back together, we have a system built on paper promises. But now, in early 2026, we are seeing a surge in people demanding the physical metal. The buffer of registered silver is low, and March is looming as the big test.
That is the summary. It is a classic clash between a leveraged financial system and hard asset reality.
Doug Young's report really highlights the self-correcting mechanisms. He's not calling for the end of the world, just a reality check.
Right. He argues that current trends illustrate mechanisms like supply incentives, higher prices bringing more metal into the market. He doesn't necessarily predict a total collapse, but he emphasizes that for the investor, distinguishing between paper positions and tangible possession is becoming essential.
It's the difference between thinking you own silver, because numbers on a screen say so, and actually holding it where you can drop it on your foot.
Precisely. In a crisis, or even just a period of high stress, possession is the only thing that matters.
So for our listeners who are fascinated by this, what should they be watching in the next few weeks? Young gave us some specific metrics.
Keep your eyes on two things. One, the ratio of open interest to registered stocks. That tells you how leveraged the system is. And two, the weekly delivery notices. If they stay high through March, things are going to get very interesting.
And watch those premiums. If the paper price drops but the price to buy a real coin stays high, you know the squeeze is still on.
Exactly. That is your real-world thermometer.
You know, it really makes you think about what ownership means in the digital age. We have all these apps and accounts, but when push comes to shove, possession is 9/10 of the law.
And in the commodities market, possession is the only law that ultimately matters. If you can't touch it, you don't own it.
A fascinating look under the hood of the global economy. Big thanks to the analysis by Doug Young for guiding us through that maze.
It was a pleasure. It's always good to remind ourselves that these numbers represent real things.
Absolutely. That's it for this deep dive into the COMEX silver squeeze. Keep your eyes on the charts, and maybe check if your silver is in a vault or just on a spreadsheet. We'll see you next time.